In this presentation, we will take a look at profitability ratios with the information, the data on the left-hand side. We're going to enter that information into the blue areas on the right side. We do recommend setting up your data in a similar format to have the data either up top or to the left with the words in separate cells as the numbers. This making it much easier to work forward and process the information as we move forward. On the left side in our information, we're going to have the financial data, including the balance sheet. We have A and B. We can think of these as two separate companies, so we can compare the data as we go, and the income statement, same type of format. Then we've got the prior year data, which we may need for some items. In other words, financial data, select accounts from the financial statements for the prior year. So we're going to start up top with the profit margin ratio. This should be a ratio that is familiar to us. We're going to have the net income and compare that to the net sales or sales item. So with net income, bottom line on the income statement, bottom line number on the income statement, we're going to say this is equal to the income statement down below. Net income, the 164,508. We're going to compare that to the top line on the income statement, that being the net sales. Remember, this isn't net income, it's the net sales, so net after allowances and discounts, which are not expenses, but are basically contra sales accounts. So in essence, top line item, net sales, which for us is just the sales of the 780,000. We'll then divide that out to give us that profit margin ratio. So the profit margin ratio, then I'm going to underline this item, is going to be equal to the 164,508 and divided by the 780,000, or the 21.1%. So what that in essence means, it is going to be the bottom line number, the net income compared to the basically top line number, sales. In essence, how much are we going away with for every basically dollar of sales that we have? What's going to be the net income or the net amount on that after expenses? We'll do the same thing for the B data. So the B data, the net income, we're going to say this is equal to bottom line number, net income, the 202,903. Then we're going to take the top line net income, the net sales. This will be equal to, on the income statement, the 898,200. Then we'll divide those two out. This will be equal to the 202,900 divided by the 898,200, or the 22.6. I'm going to underline this item, home tab font underline, probably done for you already. Let's double underline this one, home tab font, drop down, double underline. So typically the bigger number's better here, so B would typically be better than A in this case, because we want to be having, in essence, more net sales as compared to the sales number. Then we're going to be calculating the return on assets, return on total assets. We'll be comparing the net income and the average total assets. This is one of those that when you just see the formula, you're going to see that net income divided by the average total assets looks very basic. However, we're going to have to add into that, what does it mean to have the average total assets, and calculate out what the average total assets will be. So I recommend putting it into a format like this, a table like this, so you can visualize how it can be set up. So we're going to start off with the net income. We're going to start off with the net income. This is going to be the bottom line number. I'm going to put up that on the right-hand side, leaving an enter column where we will then calculate in a subcategory the average total assets. So in the outer column in S9, we're going to say that this is equal to, and we're looking for the net income, bottom line number on the income statement, which is going to be the 164,508. And then we're going to pick up or calculate the average total assets, So we're going to have a colon here so that we can have that as a subcategory. We're going to bring those into the inner side into column R. We're going to start off with the beginning assets. So we want the beginning assets. Now note, that's not going to be on our financial data, because the financial data on the balance sheet represents the ending assets at the end of the time period. We then would have to look at the beginning assets at the prior year financial statements. The end of the prior year is what's reported on the balance sheet as of last year, which of course is our beginning number for us. This is going to be equal to the data down below. We got our prior year data down below, and we want the total assets. So we're looking for the 388 beginning assets. Then we want the ending assets, and that's going to be on our balance sheet. So that's going to be equal to the balance sheet items up top. We're looking for the total assets. It's going to be the 512,740. Then we can add those up, and that'll give us our subtotal. So we're going to add those up for the subtotal. equals the sum of the 388 and the 512, 740 for the 900, 740. Then we'll go ahead and divide that by 2 for the average. So remember, the average, anytime we have the balance sheet account and we see these averages, we're taking the beginning, ending, dividing by 2, in essence getting what any average point is. We're looking for kind of an average point at any given time throughout the year, because obviously a balance sheet account represents a point in time. And so then we're going to say that the average total assets will be then equal to 900,740 divided by the 2, or the 450,370, and then the return on the assets then will be equal to the 164,508 divided by the 450,370, or 36.5. Now let's do the same thing for B. We're going to say B. We're going to start off in the outer column once again. We're going to calculate the first line is going to be net income. This will be equal to, on the income statement, we're picking up the 202,903 net income. Then we're going to go into the inner column to pick up the average total assets. We're going to start off with the beginning assets. Beginning assets will not be on the current balance sheet, but will be on the prior year balance sheet. So we're going to go to the prior year data for us, which is going to be the 402,500. And then we're going to pick up the current assets, which are the ending assets. And this is going to be equal to what is on the balance sheet. So we'll look for the assets on the balance sheet, total assets, the 540 and 50. And then we'll sum those up, equals the sum of the 402,500, the 540, 50. And that's going to give us the 942,550. We'll then divide that by 2 to get the average, which will be equal to the 942,550 divided by 2. And that's going to give us the average of 471,275. Then we can calculate the return on total assets, which is going to be the net income, 202,903, divided by the 471,275, or the 43.1%. Note this ratio is basically comparing our net income, the return, how much we're getting, the bottom line number on the income statement, as compared to the total assets, what we're to generate our net income. So we're going to want this number to be higher because we want to basically have a higher return. Our assets, the reason we have assets is to help us generate our net income. How efficiently are we using those? Well, this is our bottom line performance number on the income statement as compared to our total assets. And we want this to be higher, so B is looking better in this case because that would indicate that they're making better use of their assets than A in order to generate the net income. Next, we're going to take a look at a return on common stockholders' equity. Return on common stockholders' equity. This is going to be another one where if you just look at the formula, it's going to look like a pretty basic formula, but when you actually go through the calculations, we're going to have to do an average once again because we're comparing an income statement item, net income, as compared to the equity item, which is going to be a balance sheet account, and we'll have to do that averaging item with that balance sheet account once again. So we'll start with net income. So we're going to say this is going to be net income. I'm going to put this into the outer column. The net income bottom line number on the income statement is going to be the 164,508. And then we're going to say less the preferred dividends, if there are any. So if there's preferred dividends, we're going to take those out. In our case, there are none. So I'm going to say 0. That's going to give us our subtotal. So we'll give us the subtotal, which of course will just be the 164,508 minus 0 for the subtotal. Then we're going to pick up the average equity. So the average equity, and to do this, we're going to bring this into the inter column, and we'll break this out as a sub calculation. We'll have to do the beginning equity plus the ending equity, and then divide that by 2 because it's a balance sheet account once again. So the beginning is going to be the beginning equity is not going to be on our financial statements, not on the balance sheet, because it is a prior year number. We're going to pick that up from the prior year financial statements because the balance sheet of the prior year is as of the end of the prior year and therefore the beginning of the current year. So we're looking for the beginning equity. We're going to look in the prior year data. We've got these two items, the 170 and the 161,592 are the two equity items. I'm going to use the sum function then equals the sum to pick up the 170 and the 161,592. And then we're going to have the ending amount. So the ending equity then will be on our current financial statement equal to the sum of, and we'll pick up the ending equity amount on the balance sheet, which is going to be the 170 and the 198,600 for the 368,600. We'll sum those up, and that will be a subtotal. So I'm going to subtotal those up equals the sum, the beginning and ending equity, and then we'll take that and divide it by 2. Taking that amount, dividing by 2 to give us the average equity, which I'm going to pull out to the outer column now. This equals the 700,192 divided by 2. So you want to kind of visualize this type of calculation. How are you going to format this type of calculation when you see it? If you have to do this by hand, this is one way you do it. It's going to be a longer type of calculation, but this is what you're going to have to actually punch into the calculator. You may as well write it out in this format because it'll be easier to think through rather than having, this calculation up here and then some other calculation down here for the average and whatnot. So we're then going to calculate the end result, which is the return on equity, which will be the net income in essence minus any preferred dividends divided by the average equity, which is going to be the 47% here. Let's do the same thing for B. So I'm going to go into the outer column. We'll pick up net income first. Net income will be equal to, we're looking for the income statement, bottom line of it, 202,903. There's going to be no preferred dividends. Then we're going to subtract this out. The 202,903 minus the 0 gives us the 202,903. Then we're going to go into the enter column for the beginning equity. We're going to say that this is equal to the sum of, and we'll pull over to our equity items, and we're looking for B. We want the 196 and the 89,863 for the prior year data. Then we want the current year data, which is going to be the ending equity, because of course the current balance sheet is as of the end of the year. And we're going to sum up then the balance sheet items for the current year, which is going to be the common stock and the retained earnings, the 196 and the 136,750. Then we can sum those two items up equals the sum of the 285,863, the 332,750 for the 618,613. Then we'll divide that by 2, and I'll pull that into the outer column. This will be the average equity. The average equity then being the 618,613 divided by 2. And then we can do the final calculation, which will be equal to, in essence, the net income minus any preferred dividends, if there were any, divided by the average equity, which is going to give us the 65.6. Now, when we think about the return on equity, we're considering the net income, the bottom, the performance type number, and we're considering the average equity, which is you could think of as assets minus liabilities, or basically the book value of the company, as compared to net income. So in other words, how well are we using basically the assets minus the liabilities, the equity, as it relates to the net income. So typically we would want this number to be higher, and that's going to be, therefore, B is looking better. In this case, they look to be using more efficiently their equity, assets minus liabilities, and to generate the net income.